Hello, everybody. I think we've got 7 people with us so far. We're going to start at just a moment after 1 o'clock, and I'm going to keep relatively quiet for the next couple of minutes while people are signing in. So if you're with us already, welcome, but just be patient, and we'll be going to start in 2 or 3 minutes' time. That's one more person just joined us. Hello. We can just wait a moment or two just to allow people time to get logged in, and then we'll make a start probably about 1 or 2 minutes past 1, just see how numbers are creeping up. Of course, if for any reason you need to leave this webinar while it's in progress, it is being recorded by the ISM, and you can come back and listen to it through again later on if you wish, or if any of it's not terribly clear, then have another listen again later on. We have 8 people with us so far. We're hoping numbers might creep up a little bit from this. Let's just give that another moment or two. I've got Kim Davenport G sitting on my left here, who's going to deal with any major technical problems we get, and I hope there aren't any. Just to make a couple of obvious points before we start, which is that I hope you can all hear me clearly, but I, of course, can't hear you. If there are any problems during the course of the webinar, if you can just put a comment in the chat box, which we'll be able to see, I hope we'll be able to deal with it. But normally these things run very, very smoothly. Let's see, it's 2 minutes past 1 now. I think we need to make a start. So welcome to today's ISM webinar on setting up your business. We're going to be looking at suitable structures for running a business, in particular 7 of the most common formats. Starting with self-employment, which I suppose is the most basic format you're likely to encounter, and we'll end up by looking at limited companies and registered charities, which I suppose are probably the most complex. We've got an hour altogether. That's actually too little time to go into enormous detail, and I suppose you could say it's slightly too much time if we're just going to cover the basics. So my plan is to work my way through the formats, and then there'll be some time for you to let us have questions at the end of the session. You can send us questions during the webinar by, again, typing them into the chat box. At the end of the webinar, if you think of any questions you'd like to ask when we're finished, if you're an ISM member, do feel free to send us an email, and either myself or one of our legal team will try to respond to you later on. Anyway, let's get started. We're going to do this by looking at half a dozen case studies. They are not genuine ones, they're all fake, of course, but all of these should have one crucial element in common. And if you are relatively primitive and have got a piece of paper and a pen handy, I'd like you to start by writing down the names of the 6 organizations that we're going to be looking at, and then you can see if you can spot what they've actually got in common. The first one is my old friend Dennis Marshall. Dennis Marshall. Dennis is a self-employed musician. He's a private teacher, and he does a certain amount of performing work. So please write down Dennis Marshall's name on your piece of paper for me. That's number one. After Dennis, we're going to be looking at a slightly more complex setup. This is a quartet. It's a commercial string quartet, and it's called Captain Ismay's Quartet, I-S-M-A-Y apostrophe S. If you know your history, and you know the history of the Titanic disaster in particular, you will know that Captain Ismay was the chairman and managing director of the White Star Line. That's the company which built the Titanic, and Captain Ismay was actually on the Titanic when it sank, and he left the ship. He was saved, but rumour has it that he left the ship as the string quartet, who of course all died in the disaster, were playing on board. So that's Captain Ismay's Quartet. My third example is a Baroque ensemble. They are named after John Dowland, the English Renaissance composer, who was famous for his melancholy songs. And they are called Dowland's Dismay, a Baroque ensemble specialising in English music from the Renaissance period. My fourth one is an artist's agency, artist manager, as they call themselves these days. And they have the simple title of Charisma. And I'll spell that for you just in case you don't know. That's C-H-A-R-I-S-M-A, Charisma. An artist agency. They're fairly busy, and we'll talk about what they do later on in the webinar. My fifth one is a slightly quirky business, and it's called the Musical Gizmo Company Limited. They supply unusual musical gadgets, and again we'll talk about the sort of gadgets that they might produce for you later in the webinar. The Musical Gizmo Company Limited. And my sixth example is a charity which supports elderly musicians, and it's called Music is My Life. Music is My Life, a charity which supports elderly musicians. So we have Dennis Marshall, we have Captain Ismay's Quartet, we have Dowland's Dismay, we have Charisma, we have the Musical Gizmo Company Limited, and we have Music is My Life. And have you spotted the connection? I think my colleague to my left may have done, which is that all those organisations have the letters ISM at the heart of them. And that's a crucial factor, and I'm going to say this because if you're going to set up a business organisation, you are going to need professional advice and you're going to need professional support, and that's what the ISM is here for. So do keep the ISM at the very heart of your organisation. And I hope it's because of the ISM and what we do for the music profession that you've joined today's webinar. So let's start with my old friend Dennis Marshall. Dennis works for himself. He's a freelance performer. He gives private lessons. But the concept of self-employment can include any activities under the legal definition of trade, profession, or vocation. I'm never quite sure if musicians are in trade or if they think they're professionals or if it's a vocation. The word vocation often implies you don't make much money out of it, so I suppose for most of us that's extremely suitable. This is the most common and the most simple type of business setup. It's very different from employment. If you're self-employed, you don't earn a salary as such. You are in control over what you do, and very much in control over how you do the work that you do. You have no commitment to take on work which is offered to you. You can decline work, you can accept it, it's entirely up to you. You're also very often entitled to send deputies or substitutes. You don't actually necessarily have to carry out the work yourself. You may, for example, delegate it to an assistant. You may, with permission, send a deputy to cover your teaching for you. That wouldn't be the case if you were employed. You also supply your own equipment, certainly your own instruments, and if you're working from home, your own computer, your filing cabinet, your desk, and all the other things you need when you're working as a self-employed individual. And of course, there's an element of risk. There's an element of risk in self-employment. For a start, there's no guarantee that anyone is going to offer you work, but you do take a risk as a self-employed individual. Music, unusually, is one of the very, very few professions where you can be self-employed, before you are actually, I suppose, what you might call qualified in any sense. Many music students, even in their first year, and even some people actually still at school, are effectively working as self-employed musicians. It's not unusual for a 19 or 20-year-old to have a few private pupils, for example, and music students will certainly be regularly taking on freelance engagements if they're made available to them. So they are already self-employed, but they're not necessarily so busily self-employed that they need to register with HM Revenue and Customs as yet. Their earnings probably aren't high enough. And we'll look at what the threshold for registering is later on in the webinar. So self-employment, that's the simplest structure. And who's it suitable for? Well, with self-employment, there's very little separation between your personal and your business finances. Should you run into debt because your business has got into difficulties, then all your assets, both your personal and your business assets, can be claimed by your creditors. Let's consider a situation where you decide to promote a major concert by, let's say, hiring the Royal Albert Hall for a night. You're self-employed, so you personally sign the contract, and that makes you personally liable for the Royal Albert Hall's hire fee. You probably engage performers as well, not to mention paid for the advertising and the publicity and all the other costs associated with putting on a public concert. And you are entirely reliant on ticket sales for your income. And if no one turns up for that concert, it's no use you saying that your business has gone bust, because the whole management, and not to mention all the individual musicians that you have engaged, will come to you personally for the money that you owe them. And if you can't pay, then you can be declared bankrupt, and that may well mean that you lose your house and all your personal property. So self-employment is not a sensible format if your business has significant financial risks, such as concert promotion. Most self-employed businesses have no serious element of financial risk, and you don't need any particular protection. But if you are going to go in for things like concert promotion, then maybe self-employment is not the right format for you. So how do you register for becoming self-employed? HM Revenue and Customs now calls self-employed individuals sole traders, although I suppose as a musician you're probably not trading as such. But you can register on the HMRC website, which has now been taken over by the new www.gov.uk website, which has advice for all sorts of people that have any interaction with the government and government agencies whatsoever. And the website that you need to go to register as self-employed is www.gov.uk/ and then it is hyphenated, set up sole trader, hyphenated, /overview. And that will take you to a form called a CWF1, and you can either fill it in online, or my experience is if you do fill it online, the whole thing vanishes and it doesn't work, so we usually end up printing the thing out and posting it in. But you need the CWF1 form to register as self-employed. You have to register at the latest by the 5th of October in your business's second year. So, for example, if you become formally self-employed on the 1st of May 2015, you have to register your business with HMRC by the 5th of October 2016. There are now no penalties for registering late. That has only just happened. Until relatively recently, there was a £100 penalty for registering late. But there are still penalties for sending in your tax return late and paying your tax late. So if you register late, but you don't actually owe any tax and you don't have a requirement to fill in a tax return, there is no penalty for late registration. But I would certainly advise you to register sooner rather than later so that you're in the system, and then you're going to be notified by HMRC about the various deadlines that you need to meet with. You are, of course, if you're self-employed, liable for income tax when you've made a profit, and I refer you back to my previous webinar where we covered the basic rules on income tax. Have a look through that again, and that will tell you roughly what happens. But fundamentally, you are taxed on your profit. That's the money that's left over after you've paid out your expenses from your income. And everyone in the current year which finishes very soon on April the 5th, is allowed to earn £10,000, that's your personal allowance, before you have a tax liability. Once it goes above that figure, then you're liable at 20% tax on your profits. The thing to bear in mind, though, is that national insurance liabilities start at a lower threshold. If you're self-employed, you have to pay Class 2 national insurance. That's £2.75 a week at the moment. And that begins when your profit is above 5,885. That's pounds. That's practically half the threshold for paying income tax. So you need to register with HMRC, fill in tax returns, start paying tax and national insurance when your profit is not much more than £5,000. At the moment, Class 2 national insurance is paid direct to HMRC, but that system changes at the beginning of the new tax year when it's going to be collected with your tax payments. You will no longer have to pay by direct debit, which is the system that's mostly in place for self-employed musicians at the moment. You also have to pay Class 4 national insurance, and that's 9% of your profits above £7,956. So when you're looking at the actual tax rate for self-employment, it's not really 20%. It's actually 29% plus Class 2 national insurance. So you're looking at 30%, 31% for someone who is a basic rate taxpayer. It's practically 1/3 of your earnings. You also need to consider VAT registration. And if your turnover, that's your total income, goes above the registration threshold of £81,000 a year, not the case for very many musicians, I have to say, but you then would be required to register for VAT, and that means that you have to charge an extra 20% on most of your income. You would not need to charge VAT on private one-to-one teaching, incidentally, but if you're out there doing gigs and so on, you become 20% more expensive, and that can put certain people off booking you. So that's my relatively simple example with my friend Dennis Marshall. We'll leave Dennis to go and have a cup of coffee and move on to my next case, which is Captain Ismay's Quartet. They are a commercial string quartet. They don't exist to give concerts as such. They actually mostly perform on cruise liners, appropriate for their name, of course, where there is pretty good employment for musicians who don't easily get seasick. The quartet also make themselves available for weddings and corporate functions and so on. Most string quartets are partnerships of one sort or another, but this quartet is not a partnership. It's been set up by the principal violinist, the first fiddle, and she retains full control over everything. She chooses the other three players from a pool of musicians that she knows. She negotiates all the fees, she negotiates the contracts, she handles the publicity and the marketing and so on and so forth. None of the other players has any real obligation whatsoever to the quartet. They simply turn up when they're booked, they do the gig, they collect their fee, and they go away. The owner of the quartet, my friend who is the first violin, makes as much money out of it as she can. It's entirely up to her how much money she makes. The other players just get a fixed fee, and they have no idea how much the owner is actually being paid by the promoters that are engaging the quartet. This is actually another form of self-employment, although here the self-employed individual is engaging and paying other musicians. These musicians themselves are working on a self-employed basis. They are free to accept any work that's offered to them or to decline it. And there are therefore no employment contracts in place. All the income which the owner of the quartet receives from the engagers, from the cruise companies and so on, is her personal income, and it has to be declared as such. And the fees which she pays to the other musicians are her business expenses, along with all the other costs that she will incur. Her profit is the money which is left over, and I suppose effectively that profit comprises her fees for playing in the quartet, plus the money that she makes out of managing it. But really there's no distinction, she just makes a profit. It's important to note that if the owner is also working as a self-employed performer for the rest of the time in the usual way, there's no real separation between what you might say the two businesses that she runs. She is simply self-employed in the eyes of the law and the tax authorities. If she wishes, she could produce separate sets of accounts for the quartet and for the rest of her self-employment. But when her tax liabilities are calculated, the profits from the two sets of accounts are added together and her tax liabilities are calculated overall. She doesn't, for example, get two lots of £10,000 personal allowance just because she effectively has two sources of self-employment. And again, in the, I suppose, unlikely event that the quartet were to lose a significant amount of money somehow, how could that happen? Let's say that the quartet failed to turn up for a high-profile cruise and she was sued for breach of contract by the cruise company. Then if that were to happen, all her personal assets would be at risk. She has no protection. If her business goes bankrupt, then she goes bankrupt with it. In a case like this, registration and taxation are no different from ordinary self-employment. But remember that you can't avoid tax and national insurance liabilities by splitting the business in two. And as I said, in particular, VAT registration will be required when the total income from all your businesses added together exceeds that £81,000 a year threshold. It's the person who is registered for VAT, not the business. So if you've got 2 or 3 businesses, we have to add all the turnovers together before we work out whether you are free from having to register for VAT. So that's a more complicated form of self-employment. You're still in business on your own, and in that case, you're engaging other people to work for you. Let's move on to my Baroque ensemble, Dowland's Dismay. I enjoyed working that name out. They are an informal partnership. They're a performing ensemble, and there are 5 members. And at the moment, they just give a couple of dozen public concerts a year, but they're hoping that their work will increase, that they'll become busier as time goes on and as they build their reputation. The membership of this ensemble is fixed, and all the players have an equal say in how the ensemble is run, very different from the ISM quartet. The players share their earnings equally, so this really is a partnership. This is, though, an informal partnership in the sense that the musicians are not bound together by a formal and legally binding partnership agreement, such as the partners, say, in a firm of solicitors might have. They simply work together when an engagement comes in, but there's no long-term legal commitment on anybody. And the members of the ensemble are free to resign should they so wish. They're not legally tied together. There are a lot of these informal partnerships around. A group of musicians who does a gig in a pub and then shares out the proceeds at the end of the evening are in effect in an informal partnership. Further up the professional ladder, a professional string quartet with, say, a concert series at the Wigmore Hall and giving performances both around the UK and internationally is also likely to be an informal partnership. So who is this setup suitable for? It's unlikely that the ensemble are going to be taking on significant financial risks. So the musicians aren't too worried about whether or not they are personally liable for the debts of the ensemble, simply because there are unlikely really to be any. However, that warning about concert promotion is still relevant, although it would be, I suppose, unusual if Dowland's Dismay were to book the Royal Albert Hall for a self-promoted concert. Now, there are no registration requirements whatsoever for an informal partnership. However, the individual musicians will need to be registered as self-employed, and they will simply declare the fees that they earn from the ensemble as freelance income, just as they would from any other source. And they, of course, will be able to claim their business expenses, and those business expenses will include any contributions which they make towards the running of the ensemble. Of course, all the running expenses of the ensemble will need to be divided between the 5 members of Dowland's display, and that can lead to real complications. So let's take a brief look at how an informal partnership might manage its finances. It's all very well to split the fees at the end of each concert and then to ask everyone to contribute their share when expenses arise. But I suppose phoning all the members of the ensemble and asking them to send you 1/5 share when you've just bought a book of stamps can get a bit tedious. If you're running an informal partnership, it's a very good idea to have a bank account which is set up just to handle the finances of the ensemble. If you go to a bank and say that you want to set up an account for a musical organisation, they will immediately steer you in the direction of a business account, and they will charge you for having it, even if it does nothing whatsoever, and you need to try and avoid that if you possibly can. Some of the old building societies which converted into banks will still allow you to set up effectively a business account under another name. They may call it a treasurer's account or an association account, and you may not be done for business bank charges every month. The other option, if you really want to avoid it, is just to get 2 members of the ensemble to open an account in their joint names. Now, you will have the slight disadvantage that the name of the ensemble will not be on the bank account or on the checkbooks, but that's not really a big issue. You can ask promoters to pay money directly into that account by giving the sort code and the bank account number. If people want to write you a check, you simply ask them to write a check to the name of one of the 2 names who are actually on the bank account. Now, when you open up the bank account, every member of the ensemble pays in an agreed float. Let's say it's £100. So we now have, in my case of Dowland's dismay, £500 in that account, and that money is used to pay the initial setup costs of the ensemble. Let's imagine you need to buy music stands, or you need to pay to have a brochure done or some photographs taken or whatever. That money is then paid out of the bank account using that initial £500. The £100 that you have each contributed is a business expense. You can claim that £100 as a tax expense against your income generally. Now, every time the ensemble does a gig, does a concert, an agreed proportion of the fee is retained in the account. So let's imagine that the ensemble, which has 5 members, does a concert, and its fee for doing the concert is £600. Each of the members of the ensemble might claim a concert fee of £100. That's £500 of that money gone, and the £100 extra is left in the account to cover expenses. And progressively, as you do more and more concerts, so more and more money is left in the account, and that covers the expenses of the ensemble. If you find yourself building up a large amount of surplus money, then you can all pay yourselves an extra concert fee without actually having to give a concert. If you find, though, that the money you're saving from the work that you do is not enough to cover the business expenses, then you may all need to make a further contribution, let's say another £50 into the account to keep it floating. Now, it's essential, of course, that you only pay business expenses from this account. You can't, for example, say, oh, we've got £300 in the account, let's go and spend it on a slap-up meal with our wives and girlfriends and husbands and everybody else. That would be illegal. It has to be business expenses. Now, therefore, what happens if a member of the ensemble resigns? Without this setup, they could argue that 1/5 of your ensemble's assets, I suppose the viola part or the music stand that they use, would belong to them, and they could wander off with it, which wouldn't be very good news. Now, in this case, they withdraw their initial float, their £100 that they put in at the beginning, and anything else which they're paid in subsequently. And when a new member is appointed, they pay in the same amount, and therefore they effectively buy into the partnership at the same cost as everybody else, and that gives you continuity. The important thing as well is that you are not allowed to run up an enormous amount of undistributed profit within the bank account. I'm just checking I'm still functioning here because my screen seems to have frozen, so let's assume you can still hear me all right. HMRC will allow this format to continue, provided that the individual musicians declare the money which they, are we still functioning? You think we are? We're just checking we haven't got a technical problem. I think we're fine here. Yeah, okay. HMRC will allow this method to function, provided all money that is actually withdrawn from that bank account is declared in the individual musician's tax returns. That's basically how to run the finances for an informal partnership like that. Now, let's go back to Dowland's dismay and find out what happens if they get busier. They might become so busy that the ensemble is becoming a very significant part of their professional lives with, say, I don't know, a university residency, a summer festival, and a couple of concert series each year. They could very well decide to set up as a formal partnership. This would mean that they would want to draw up a partnership agreement which would set out the terms and conditions of their mutual relationship. And in addition, the tax arrangements would be different. A formal partnership needs to register with HM Revenue and Customs, just as a self-employed individual has to register. Accounts would have to be prepared for the ensemble annually, and the ensemble would have to submit an annual partnership tax return. However, the partnership itself would not pay tax as such. The individual partners would declare their own shares of the partnership profits in their personal tax returns, and they would still be liable for their own tax payments. If you look at the personal self-assessment tax return, and if you get all the pages that you're entitled to ask for, you'll find that there is a partnership page, and on that page you declare your share of the profit from any formal partnerships that you happen to be a member of. Of course, there's nothing to stop the individual members of the partnership, the formal partnership, being self-employed as well. They are likely to be taking on freelance work when they're not working with the ensemble. But because there is a formal partnership in place, their self-employment accounts will not include any income or expenses which relate to the formal partnership. Now, once again, there is unlimited liability here. That means that the members, even of the formal partnership, do remain personally liable for any debts. So again, formal partnership is not a safe way of running a business if you are going to be incurring significant debts or risking large amounts of money. I'm going to ask Kim on my left if we have a problem with the webinar, because we've still got a jammed up screen here, and we assume that you can still see me while I'm talking, but if not, I'll carry on talking on the assumption that you can. So let's move on. That's informal partnership and formal partnership with Dowland's dismay. Now, my next example is a musical agency. They are called Charisma, and they are run by 3 partners. They've got quite a few artists, and the 3 partners work for the business full-time. They also employ a small staff. The profits which the agency makes are shared between the partners in an agreed ratio, and they have a formal partnership agreement which was drawn up by their solicitor. They are handling considerable amounts of money, and because they don't want their personal assets to be at risk, they need what is called limited liability. That means that should the business run into serious financial difficulties and find itself unable to pay its debts, the creditors could not insist on the partners delving into their own pockets to make up the shortfall. So the partners want to protect themselves financially, and so rather than setting up an ordinary partnership, they decide to register as a limited liability partnership. In many ways, this is actually similar to an ordinary partnership in that the partners remain liable for their own personal tax. Accounts will be prepared for the partnership, and the individual shares will be declared in their personal tax returns. There are, however, some very significant differences. First, a limited liability partnership has to be registered with Companies House as well as with HM Revenue and Customs. And it will have to put the letters LLP after its name. So Charisma on its letterhead will say Charisma LLP. That LLP serves as a warning to anyone who has financial dealings with the partnership that they will not be able to pursue the individual members, the individual partners, should the partnership be unable to pay its debts. Annual accounts and returns must be filed with Companies House, and those documents are open to public inspection. Fees apply when the LLP is registered with Companies House, and there are annual filing fees for filing the accounts and the return. These fees vary according to whether the filing is electronic or whether it's done by post. And just to give you one example, the annual fee for filing a paper return is £40, but that's reduced to only £13 for an online submission. There's quite a lot of work involved in running an LLP because you're dealing with two organisations. You're going to be dealing with HM Revenue and Customs, particularly for calculating the tax liability, but you're also going to be dealing with Companies House on a regular basis. There really is no point in setting up a limited liability partnership unless you really do feel that you need the protection of limited liability, protection of your personal assets. And in most cases, you'll only be doing that if either you're handling other people's money, as in the case of Charisma, who are handling the fees which are due to their artists, or if you're risking large amounts of your own money. So that's the other form of partnership. We've looked at informal partnership, we've looked at formal partnership, and now we've looked at limited liability partnership. Limited liability partnerships are on their way towards becoming a proper company, I suppose you could argue. And my fifth example is the Musical Gizmo Company Limited, sellers of musical gadgets. Let's say that they make all sorts of musical items, including personalized metronomes, self-folding music stands, violin bows which rosin themselves automatically when the hairs start to dry out, and piano stools which sense your height and adjust themselves without you having to press any buttons. They have a large international turnover, and their products are manufactured in China and Japan. The business is owned by 5 individuals who have contributed quite a lot of capital personally. One of these individuals works full-time for the company as its managing director. Another one has no day-to-day involvement whatsoever, but is still an investor in the company and collects his share of the profits, of course. This is the classic scenario for forming a limited company. The owners of the company aren't necessarily involved in the day-to-day running of the business, and while they are prepared to risk their initial investment, they do not want any liabilities for the company's debts beyond that. Most limited companies have what is called a share capital. That is money that is invested in the company when it is first set up. And the dividends, the shares in the profit, are paid to the shareholders in the proportion of the shares that they own in the share capital. So let's imagine that the initial investor contribute £100,000 towards setting up that company. One shareholder may have contributed 10,000, so he will be entitled to 10% of the profits. Another one may have contributed 50,000, half the initial share capital, so he will be responsible. He will be entitled to receive 50% of the profits. Of course, the shares can be sold, and the shares may gain in value as the company does progressively better. It's important to understand that a limited company is an incorporated body, and if you know your Latin, you will appreciate that the word incorporated effectively means to create a body. This is an essential concept. A limited company has a legal existence which is completely separate from its members or its owners. In effect and in law, A limited company is a person, and it can have debts which are separate from its owners. It can be sued in its own right, and it can go bankrupt with no knock-on effect on the shareholders or on the directors, provided, of course, that they have been running the company legally. This is completely separate from the situation with a sole trader or a partnership, where the individuals are themselves the business. In most cases, they remain personally liable for everything that their business does, although the relatively new limited liability partnership structure does give you some financial protection, as we've seen. There are two ways of setting up a limited company. You can do it yourself, but the documentation is really, really complicated, and it's easy to make a mistake with the paperwork. It's much easier, much simpler to buy a ready formed company from a company formation agent. And you can do this for as little as £20. If you just try Googling limited company, you'll see what's on offer. These agents set up large numbers of limited companies with temporary names, temporary shareholders, and temporary directors. And if you want to buy one, the name is changed to fit with your requirements, the shareholders are changed, the directors are changed, and off you go. It's as simple as buying a CD online. As with limited liability partnerships, registration is with Companies House. However, the taxation arrangements are completely different. Limited companies don't pay income tax, they pay corporation tax, and the liability for the tax stays with the company and not with the shareholders. Corporation tax is assessed on the profits. The current rate for most businesses is 20%, and there is no annual personal allowance. So if a company makes a profit of £1, it has a corporation tax liability of 20p. If an individual makes a profit of £9,000, they are under the personal allowance threshold and they pay no tax whatsoever. Once the corporation tax has been paid, then the profits, or at least some of them, depending on how the directors want to run the business, can be distributed to the shareholders in the proportion of their shareholdings. But they don't have to be distributed, of course. The directors of the company, who may not necessarily be the same people as the shareholders, may decide to plough all or some of those profits back into the company in an attempt to grow its profitability, or they may simply decide that they want to hold some money in reserve. So if you are a shareholder of a limited company, don't expect to receive your share of the total profits that the company makes after the tax has been paid. You may receive all of them, you may receive a proportion of them, but the running of the company is handled by the directors on a day-to-day basis, and they are not necessarily the same people as the shareholders, although the shareholders usually retain the right to appoint the directors. I'm going to mention the fact that some musicians believe that you can save an enormous amount of personal tax when you are self-employed by turning yourself into a limited company, even if you don't actually need the protection of limited liability. This is true to some extent. A limited company doesn't pay tax at the higher rate if its income goes up. Now, if you are a self-employed individual and your profit is more than about £42,000 to £43,000, you'll find yourself being taxed at the 40% rate. A limited company that makes a profit of £40,000, £50,000, £60,000 still pays tax at 20%. So you can argue that a limited company potentially pays less tax when income is higher. That's fine in theory until you actually draw the money out of the company, because when you draw the money out of the company, it becomes your personal income. And if you, let's say, take a dividend and you are a 40% taxpayer, then you'll pay top-up tax when the dividend comes to you, which pushes up the rate to the same rate as it would be if you were self-employed in the normal way. So what are the attractions of becoming a limited company when you're self-employed? Well, for a start, there aren't any at all unless you are potentially a higher rate taxpayer. So if your profits are less than £43,000, there is no benefit whatsoever. There is potentially a benefit in saving on national insurance. Okay, you will look at a combination of paying yourself a salary from the limited company and some dividends as well to distribute the profits, and you will not pay as much national insurance. But there are catches. One catch, of course, is that if you are a limited company, your accounts, your personal accounts, as they may still seem to you, are open to public inspection. Anybody can look at how much you're earning, and you may not be too happy with that arrangement. The other catch, of course, is the government may change the rules, and this regularly happens. So that today it may be less, if you may find yourself with a smaller tax liability if you're a limited company, but tomorrow, in fact there's a budget coming up next week, that situation may change. And what you cannot do is hop backwards and forwards between being a self-employed individual and a limited company. There are all sorts of complications involved in doing that. If, for example, you have relatively expensive equipment and you've set yourself up as a limited company, if you no longer want that limited company, then your limited company has to sell that equipment back to you personally, and that can involve lots and lots of very expensive tax liabilities, which is not what you want. Compliance costs are much more expensive. You're going to be dealing with Companies House, and you're going to be dealing with HM Revenue and Customs as well at the same time. And there can also be horrible complications if you're working overseas and tax is deducted at source from the gig you did in, let's say, the USA or France, where the situation is much more complicated if you've got a limited company registration. So on the whole, I would say I would avoid setting up a limited company unless you really genuinely do need the protection of limited liability, unless you are making really, really serious money when it might be worth going to a good accountant and asking for some advice. But really, unless you're making 80, 100,000 a year or beyond, I would steer clear of it. Let's look at my next example. Music is My Life, which is a registered charity. It's registered in that it's an incorporated body, rather like a limited company, and it's registered with the Charity Commission. And it's a charity in that it exists to provide public benefit. And public benefit is quite tightly defined these days, but it covers things like the relief of poverty and education, and fortunately for us, the promotion of the arts. A charity is almost invariably run by a board of trustees. There's usually a minimum of 3 of them, and they are not paid for their work as trustees. They can, in certain circumstances, be paid for other work which they do within the organisation, within the charity, but it's usual for the trustees and the staff to be completely separate. Charities are what are called not-for-profit organisations. It's a rather unusual term. It doesn't mean that they set out not to make any money, but it does mean that if they do make profits, those profits are not distributed to owners or shareholders. They are ploughed back into the business to achieve the charitable objectives. Until recently, most charities were set up as companies, which were registered with Companies House in the usual way, much like my musical Gizmo Company Limited. And they were also registered simultaneously with the Charity Commission, who confirmed that those companies were set up for charitable objectives. This meant that all the paperwork had to be submitted both to Companies House and to the Charity Commission. And there were fines imposed by Companies House if your paperwork was late. It's still possible to use that setup to set up a charitable company and to register with the Charity Commission separately. But there is now another option, only introduced in the last 2 years, and this is called the Charitable Incorporated Organisation, the CIO. Everything now is handled by the Charity Commission. There is no need for the CIO to register with Companies House, and the whole process is much simpler. The Charity Commission even provide you with a sample constitution with various options in it, and you can then tailor it to fit what you actually want. They will also help you with the public benefit test, often by sending you copies of successful applications which have been sent in by other charities which are doing a similar job to what you are doing. So if you want, for example, to set up an orchestra as a charity, they will send you examples of submissions made by orchestras which have already obtained charitable status to show how to go about it. Registered charities don't pay tax, but this, of course, doesn't mean that their staff don't pay tax in the normal way. Neither do they have to register for VAT. They can also claim gift aid tax relief on donations made to them. Now, do you know how that works? It means that if somebody makes a donation to a registered charity, the tax which that person has paid on the money they're going to give you is then paid back to the charity by ISM Revenue and Customs. Let's briefly look at a genuine example of that. Let's imagine that you give £80 to a registered charity. That £80 is your income after your tax liabilities have been paid. You will have had to have earned £100. You would have paid £20 tax on it. That would have left you with the £80 which you want to give to the charity. So your £80 has actually cost you £100, and that's what you earned initially before you paid your tax. That £20 difference is then reclaimed from HMRC by the charity, so they actually get the £100 in full. Effectively, therefore, gift aid increases the value of donations by 25%, by a quarter. Most arts organisations are registered charities. They work for the public benefit. They promote the arts, and they are ultimately governed by an unpaid board of trustees. The employed staff will be responsible for the day-to-day management. If you're planning to set up an organisation which may attract donations or grants, then a registered charity may be the right format, but finding suitable trustees can be a big problem. The trustees are legally responsible for assuring and ensuring that the charity remains legally and financially compliant, and the buck really does stop with them if and when things go wrong. So there we are. Unless you are doomed to being in full-time employment for the whole of your working life, at least one and possibly more than one of these business formats will be relevant to you. You may, like Dennis Marshall, spend your professional life as a self-employed person, a sole trader, as HM Revenue and Customs will describe you. Perhaps your self-employment will therefore involve engaging other musicians, as does the owner of Captain Ismay's quartet, still a sole trader, but beginning to make money out of other people, and that might start to give you bigger ideas about really being in business. Perhaps, like Dowland's Dismay, you may find yourself in a partnership with a few colleagues. Initially, this might be nothing more than an informal partnership, but as you get busier, you may need a formal partnership agreement, with the partnership preparing its own accounts and submitting its own tax returns. If you're worried about financial risk, then you may want to look at a limited liability partnership where the partners register with Companies House. Charisma, my artist agency, have done this. The partners are still responsible for their own tax, but if things do go seriously wrong, their creditors will not be able to bankrupt them personally and individually. The Musical Gizmo Company Limited is much more what people expect when they think of a registered company. There are shareholders, they pay dividends, and there is a staff. The company pays corporation tax, and the profits are distributed to the shareholders in the proportion of their shareholdings. If things go badly wrong and the company goes bust, the individual shareholders, the investors, will lose their investment, but that's all they will lose. And finally, music is my life, doing good works with a board of dedicated trustees and no tax to worry about other than dealing with its employees' PAYE and claiming back gift aid on the donations it receives. Of course, there are other business structures, but you're not likely to encounter the rest of them very often. Above all, however, all the businesses that we have looked at today have the letters ISM at their very heart, and there's a message there for anyone trying to survive within the music profession. We've got 7 minutes. If you want to send in some questions now, we've got a little bit more time to have a look at them. But otherwise, as I said, if you want to send in questions by email to the ISM, if you are a member, of course, then we will try and deal with them over the next few days for you. Now, I've had one question in. Can I read this question out? I'm self-employed as a choir leader running a local choir sessions for a national chain of choirs. We're being asked to become limited companies. It looks like we won't have a job if we don't do this in the near future. We've been told that if we're earning above £14,000, we'll be no worse off becoming a limited company, and that it will be a benefit to us the more we earn. Is this the case? You get a lot of this with organisations trying to persuade the people that interact with it to become a limited company. I'm not, I have to say, in favour of it. It may not cost you more in tax, it may not necessarily cost you more in national insurance, but it's a bit of a pain because you're dealing with company's house, and you're dealing with HM revenue and customs and so on and so forth. This is Krista Hugo, isn't it? Krista, I would suggest that we have a little look at this. Are you a member of the ISM? If you are, can you email us in? And I'd like a little bit more information about what's actually going on here, and I'll give you some personal advice on it. But you get this with people running IT companies. It's not necessarily the format that you want, and it can create all sorts of other complications with the rest of your self-employment. Email me, and I'll get back to you, as we say, with a no obligation response, and see if we can help you out of that situation. But if they're insisting that you become a limited company, you may have no choice. You're basically self-employed, and they have no obligation to continue engaging you. Any other questions, anybody? Right, I think we're drawing to the end of our time. It's 1:55. Thank you for joining me today here at the ISM. I hope you're getting lots and lots out of your membership. The more members you recruit for us, the more successful and more influential we can become for the profession. Keep in touch, and I hope you've enjoyed today's webinar. Thanks so much. Goodbye. That's the end of the webinar. There we go.
Something came in right at the last minute, but I think it was somebody just saying a wonderful webinar. Yeah.